Right now, as you watch this video, the credit card industry is generating revenue from you, even if you've never paid a single dollar of interest in your life. Even if you pay your balance in full every single month. Even if you think you've beaten the system with your rewards card, the credit card industry is one of the most profitable, most sophisticated, and most strategically engineered financial systems ever built. And the vast majority of the 191 million Americans who carry a credit card right now have no idea how it actually works, who profits, how much, and from exactly which of your behaviors. Today, that changes. We're going to pull back the curtain on the complete credit card business model, the 4 separate revenue streams banks run simultaneously, the psychological systems built to extract money from you without you noticing, and the specific traps that cost ordinary Americans billions of dollars every single year. And at the end, I'm going to show you the exact playbook for using credit cards in a way that flips the system in your favor. Not some surface-level pay-your-bill-on-time advice. The actual mechanics of how to use the machine without being used by it. Let's start with the scale of what we're talking about. $2 trillion. Since 2010. Let that land for a second. This is not an accident. This is an engineered system. And it is time you understood exactly how it works. Before we get into how banks make money, you need to understand the 4 players in every single credit card transaction. Because most people think there are 2, you and your bank. There are actually 4. And understanding all 4 is the key to understanding the whole system. Player 1. You, the card hole. You swipe your card, tap your phone, or enter your number online. You are the transaction generator. Every time you use your card, you set the entire machine in motion. You're also the primary revenue source. Through interest, fees, and behavior the system is specifically designed to encourage. Player 2. Your bank, the card eddy. Chase, Bank of America, Citi, Capital One, Discover, American Express. The company that actually gave you the card. They issued your credit line. They own the relationship with you. And they collect interest if you carry a balance. They are the primary beneficiary of the system. Player 3. The merchant. The store, restaurant, website, or business where you made the purchase. They desperately want you to pay with a card because it's convenient and drives sales. But they pay a price for that convenience. Every single time. More on this shortly. Player 4. The network Visa/MasterCard/Amex/Discover. This is the player most people don't know exists. Visa and MasterCard are not banks. They don't issue cards. They don't lend you money. They are the payment rails. The infrastructure that routes the transaction signal from the merchant's terminal to your bank and back in about 2 seconds. And they take a cut of every transaction that rides their network. Every single one. All day. Every day. Now that you know who's at the table, let's talk about the money. Specifically, the 4 revenue streams the credit card industry runs simultaneously on every cardholder. Here are the 4 ways the credit card industry extracts money from every cardholder, through every transaction, every month. This is the engine, the core, the reason the entire system exists in its current form. When you carry a balance on your credit card, meaning you don't pay the full amount owed by the due date, the bank charges you interest on that remaining balance. That interest is expressed as an APR, annual percentage rate. And in 2026, that number is at near historic highs. Here is the math that should make every credit card user pause. Now scale that up. There are 191 million Americans carrying a revolving credit card balance. 191 million people. Each paying, on average, over $1,400 per year in interest. You don't need a calculator to see why the credit card industry generates more profit than almost any other sector in American finance. The grace period. The detail that changes everything. Here's something your bank probably didn't explain clearly when you got your card. Most credit cards offer a grace period, typically 21 to 25 days after your statement closing date, during which no interest accrues on new purchases. If you pay your full statement balance before the due date, every month you pay zero interest. Zero. The APR is completely irrelevant to you. This is how the system is supposed to work. It's how it was sold to you. But the bank knows, from decades of behavioral data, that most people won't do it consistently. Life gets in the way. A big month happens. They pay the minimum. And the moment they carry any balance forward, the grace period disappears on existing charges, and interest starts compounding immediately. The minimum payment trap. This is the most expensive design in consumer finance. Your bank gives you a minimum payment option. It sounds helpful. It's not. It is, without question, the most financially destructive feature in the credit card system, and it's designed that way intentionally. Let me say that again differently. You borrow $6,618. You pay the minimum every month. 14 years later, you have paid $13,109 total. For $6,618 worth of stuff, the bank collected more in interest than you originally borrowed. And on a $5,000 balance at 24% APR, minimum payments only? It takes over 10 years and costs you more than $5,000 in interest alone. You pay double for everything you bought. Here's the revenue stream that works even if you're a perfect credit card user, even if you've never paid $1 of interest in your life. Every single time you swipe. When you use your credit card at a merchant, that merchant pays a fee to accept the payment. This fee is called an interchange fee, sometimes called a swipe fee. It typically ranges from 1 to 3% of the transaction amount, depending on the card type, network, and merchant category. Now scale that number across every credit card transaction in America. Trillions of dollars in annual spending. At 1 to 3% per transaction, year after year. The merchant absorbs this cost. And merchants aren't charities. They build these fees into their prices. So in a very real sense, when you pay cash or debit at a store, you are subsidizing the interchange fees generated by credit card users. The entire retail economy is quietly paying for the credit card infrastructure. This is why some smaller merchants impose credit card minimums, offer cash discounts, or specifically ask you not to use premium rewards cards. Premium cards carry higher interchange fees than standard cards. Your 3% cashback card costs that merchant more than a standard card. Who captures the interchange? Issuing bank. Your ANC receives the largest share, typically 1.5% to 2.5%. This is significant revenue even from customers who never pay interest. Card network, Visa, Cotro, receives a smaller assessment fee, typically 0.1% to 0.14% per transaction. Tiny per transaction, enormous in aggregate. Acquiring bank receives a small portion for processing and managing the merchant relationship. The third revenue stream is the most straightforward direct fees charged to cardholders for specific behaviors, or simply for holding the card. Annual fees. Premium rewards cards, the ones with the most attractive perks, commonly charge annual fees of $95, $250, $550, or even $695 per year. The bank's calculation is simple. If the cardholder values the perks enough to pay the fee and uses the card heavily, the interchange revenue plus the annual fee covers the rewards cost and generates profit. The annual fee also creates a psychological commitment. You've paid for the card, so you use it more to get your money's worth. Late fees. Miss a payment, even by 1 day, and you're charged a late fee. In 2026, late fees can run up to $40 for repeat offenses. The Consumer Financial Protection Bureau estimated late fees cost Americans $14 billion per year before a proposed cap was challenged in court. Beyond the fee, a late payment can trigger a penalty APR, sometimes over 29.99%, that may apply to your entire balance going forward. Foreign transaction fees. Most standard cards charge 1% to 3% on every purchase made in a foreign currency or processed through a foreign bank. If you travel internationally and don't know your card has this fee, every purchase costs you 3% more than the price tag shows. On a $5,000 international trip, $150 in invisible fees. Cash advance fees. Using your credit card to withdraw cash from an ATM triggers a cash advance fee, typically 3 to 5% of the amount withdrawn, with a minimum of $5 to $10. Worse, cash advances carry a higher APR than regular purchases, often 25 to 29%. And there is no grace period. Interest begins accruing the moment the cash is dispensed. This is one of the most expensive financial moves available to an ordinary consumer. This is the one that people think works in their favor. And sometimes it does. But the full picture of how rewards programs actually function, who designed them, who they serve, and what they're engineered to do, is something the bank's marketing department would prefer you never fully understood. How rewards are funded. Your 2% cashback card doesn't generate that money from thin air. It's funded primarily by interchange fees. When the bank collects 2.2% in interchange from a merchant, it pays you back 2% and keeps 0.2% as profit. This is why premium rewards cards carry higher interchange fees. The bank needs the extra margin to fund the more generous rewards. This creates an interesting redistribution effect that academic researchers have actually studied and quantified. The breakage problem. Banks profit not just from rewards you earn, but from rewards you never redeem. This is called breakage in the industry. Points that expire. Miles that go unclaimed. Rewards that get locked behind confusing redemption systems or blackout dates. Industry estimates suggest 30% or more of all earned rewards are never redeemed. How rewards are engineered to make you spend more. The reward system is not designed to thank you for spending. It's designed to increase how much you spend. Here is the behavioral engineering. Explicitly, spending thresholds. Earn 80,000 bonus miles after spending $4,000 in the first 3 months. This forces rapid spending to capture the bonus, spending you may not have planned. Category bonuses. 5% back on dining. Creates a psychological nudge to use the card specifically in categories where you might otherwise have used cash or debit. Progress psychology. Watching your points total grow creates a dopamine loop. The gamification of spending. Points feel like winning. The bank knows this because they designed it. Fear of losing. Use your card in the next 90 days. Or your points may be forfeited. Artificial urgency drives spending to protect existing rewards. The credit card system isn't just financially engineered, it's psychologically engineered. Banks have decades of behavioral data and billions of transactions. They know exactly what makes people spend more, pay less, and stay in debt longer. And they have built every element of the product around that knowledge. The pain of paying? Eliminated. Behavioral economists have identified what's called the pain of paying, the psychological discomfort that occurs when you physically part with money. It's why handing over $80 cash at a restaurant feels more significant than swiping a card for the same amount. The physical transaction of cash creates a tangible sense of loss. Credit cards eliminate this pain almost entirely. There's no physical depletion, no wallet getting thinner. No moment of calculation. Just a tap, a swipe, a click. The purchase and the payment are separated in time by 30 days, and in the brain's perception, they barely feel connected. Behavioral research consistently shows people spend 15 to 30% more when using cards versus cash. Rewards cards, with their positive reinforcement on each transaction, amplify this effect further. The anchoring effect of the minimum payment. Here is one of the most studied and most damaging psychological features of the credit card statement. When your bank shows you a minimum payment amount, that number anchors your behavior. Psychological research shows that cardholders who see a minimum payment listed pay significantly less than cardholders who see no minimum listed, even when they intended to pay more. By displaying the minimum prominently, the bank implicitly communicates, "This is a reasonable amount to pay." Your brain anchors to it. You pay closer to the minimum than you would have otherwise. More balance carries forward. More interest accrues. The bank collects more money. The good standing illusion. As long as you make your minimum payment on time, your account is in good standing. No warnings, no alerts, no indication that you are systematically paying hundreds of dollars per year in interest while your balance barely moves. The statement design shows you your spending, your minimum due, and your balance, but it does not prominently show you how much you're paying in interest annually or what it will cost you to pay off this balance at your current rate. In 2009, the Card Act required banks to include a minimum payment warning, showing how long it takes and how much it costs to pay the balance at minimum only. But it's buried in the fine print of your statement. It's there. Most people never read it. The gamification of spending. Modern rewards apps show you progress bars toward the next reward tier. Points totals displayed prominently. Personalized notifications. You're 200 points away from gold status. These are not service features. They are game mechanics, identical in design to the systems that keep people playing mobile games for hours. The goal is behavioral engagement. And more engagement means more spending, more interchange, more interest, more profit. Let's zoom out from individual behavior and look at what this system costs Americans collectively. Because when you see the numbers at scale, it becomes impossible to view the credit card industry as a neutral service. That last number deserves its own moment. 49% of Americans now view credit card debt as normal. Not as a tool that went wrong, not as a crisis, as a normal part of adult financial life. That shift in perception, from "this is a problem to fix" to "this is just how it is," may be the most consequential victory the credit card industry has achieved. Because the moment debt feels normal, the urgency to eliminate it disappears. The minimum payment becomes permanent. The interest becomes a monthly fact of life, and the bank collects that $1,474 per cardholder per year, indefinitely. 83% of Americans believe the government should cap credit card interest rates. A Vanderbilt University analysis found a 10% cap would save Americans $100 billion per year. Now that you understand exactly how the machine works, let's talk about how to use it without being used by it. Because credit cards, wielded correctly, are one of the most powerful financial tools available to ordinary consumers. The goal is to capture every benefit while triggering zero of the revenue streams that extract money from you. Rule 1. Pay your full statement balance every single month. This is the master rule. The one that makes everything else possible. When you pay your full statement balance before the due date, every month without exception, you eliminate 100% of interest charges. The 21.52% APR becomes completely irrelevant to you. Activate the full grace period on new purchases. Your money stays in your account earning interest until the due date. Maintain all the benefits, rewards, purchase protection, fraud coverage, credit building at zero cost. Set up autopay for the full statement balance, not the minimum. This removes the possibility of a missed payment and ensures you never accidentally pay only the minimum due to forgetfulness. Rule 2. Treat your credit card exactly like a debit card, only charge what you already have in your checking account. Before you swipe, ask, could I pay cash for this right now? If the answer is no, the card is not the solution. It's the trap. The credit card should be a payment convenience tool, not a borrowing tool. The moment you use it to buy something you can't currently afford, you've entered the interest economy. Rule 3. Choose your card based on how you actually spend. Rewards only benefit you if they align with your actual behavior. A 5% dining cashback card is only valuable if you regularly spend significantly on dining. A travel rewards card is only valuable if you travel frequently and will actually redeem the points. If your spending is general and varied, a simple 2% flat cashback card on everything is often the most straightforward and genuinely valuable option. Calculate your actual net benefit. Rewards earned minus annual fee. If that number is negative, the card is costing you money. No benefit of perks offsets a negative net reward. Rule 4. Never take a cash advance. Ever. There is almost no financial situation where a credit card cash advance is the right answer. If you need emergency cash, your emergency fund is the right answer. If you don't have an emergency fund, building one is the priority. A cash advance at 27% APR with no grace period and a 5% upfront fee is one of the most expensive forms of consumer credit in existence. Rule 5. Understand and monitor your credit utilization. Your credit utilization ratio, the percentage of your available credit limit that you're using, is the second most important factor in your credit score after payment history. Carrying balances above 30% of your credit limit hurts your score significantly. Above 50% damages it severely. Keeping utilization below 10% is optimal for credit score maximization. Rule 6. Call and negotiate if you're carrying debt. If you are currently carrying a credit card balance, call your bank and request an interest rate reduction. Ask for your account to be reviewed for a lower APR. Studies show approximately 70% of cardholders who ask receive at least a partial rate reduction, particularly if they have a history of on-time payments. A 5-minute phone call could save you hundreds of dollars per year in interest. Also explore 0% balance transfer offers. Many cards offer 0% APR on transferred balances for 12 to 21 months. If you can pay off your balance within the promotional period, this can save thousands in interest. Be aware of the transfer fee, typically 3 to 5% of the balance, and ensure you have a concrete payoff plan before using this strategy. Let's close with the complete picture. The credit card industry runs 4 simultaneous revenue streams on every cardholder in America. Interest charges, averaging 21.52% APR, collected from the 53% who carry a balance. Interchange fees, 1 to 3% per transaction, collected on every swipe, from every cardholder, whether you pay interest or not. Cardholder fees, annual fees, late fees, foreign transaction fees, cash advance fees, collected directly and often invisibly. Rewards breakage, the 30% of earned points that are never redeemed. Booked as profit. These revenue streams are supported by a psychological architecture. Payment decoupling, minimum payment anchoring, the gamification of rewards, all engineered to maximize the bank's capture of your money while minimizing your awareness that it's happening. The United States has paid $2.1 trillion in credit card interest since 2010. That is not the cost of a service. That is the cost of a system most people never fully understood. Now you understand it. Here's your one action from this video. Pull up your last credit card statement. Find the interest charges line. If it's 0, you're playing the game correctly. If it's not 0, that number, multiplied by 12, is what this knowledge is worth to you per year if you act on it. Subscribe for weekly finance videos that give you the actual mechanics, not the surface advice. And drop a comment below. Did you know about interchange fees before today? Most people don't. Tell me what surprised you most. See you in the next one.